February 26, 1995. A 233-year-old British banking institution, survivor of the Napoleonic Wars, financier of the Louisiana Purchase, banker to the Queen herself, filed for bankruptcy administration. The cause? One trader, one office, one account numbered 88888. Nick Leeson, 28 years old, had accumulated losses exceeding $1.3 billion. Barings Bank, the oldest merchant bank in London, collapsed in less than 72 hours. The British government refused to intervene. No bailout materialized. By the time regulators arrived at Barings' Singapore office, Leeson had vanished, leaving behind a handwritten apology note and fraudulent records spanning 3 years. This wasn't a complex financial scheme involving hundreds of conspirators. One man destroyed an empire built over 2 centuries. The story begins in Watford, England, 1987. Nicholas William Leeson grew up in a working-class household where his father worked as a plasterer. Nothing about his background suggested future prominence in international finance. He left school at 18 without university credentials, joining Coates & Company as a clerk processing check deposits. Banking families controlling Barings could trace aristocratic lineages back generations. Leeson filed paperwork in basement offices. Yet within 5 years, he would be managing derivative trades worth billions in Singapore's financial district, trusted implicitly by executives who never questioned his methods. The gap between his origins and his position reveals something crucial about how Barings operated and why it failed. The bank prized loyalty and presentation over scrutiny. They saw what they wanted to see, a hard-working young man generating extraordinary profits. What they missed was mathematically impossible. No trader legitimately produces gains that consistent without corresponding risk. But Barings' management structure, unchanged since Victorian times, couldn't distinguish between genius and fraud. By 1992, Barings executives celebrated Leeson as their star performer in Asian markets. Internal memos praised his exceptional abilities. He received bonuses totaling hundreds of thousands of pounds. Senior partners discussed promoting him further. Behind closed doors in Singapore, Leeson was falsifying records daily, hiding mounting losses in account 88888, a number deliberately chosen because it means prosperity in Chinese numerology. The prosperity was an illusion, the losses were catastrophic, and Barings' 233-year legacy hung in the balance, sustained only by fabricated spreadsheets and the misplaced trust of men who should have known better. When Barings Bank collapsed in February 1995, financial analysts initially assumed complex derivative fraud involving multiple conspirators, sophisticated computer manipulation, or international money laundering networks. Investigators discovered something far more disturbing: basic accounting fraud that any competent auditor should have detected within weeks. One trader, operating from a single desk in Singapore, had hidden $1.3 billion in losses using methods so simple they belonged in a textbook on internal control failures. Nick Leeson didn't possess advanced mathematics degrees or programming expertise. He understood derivatives trading at a functional level, sufficient for executing transactions but nothing exceptional. His real skill lay in exploiting institutional blindness. Barings operated on centuries-old assumptions about trust, hierarchy, and the fundamental honesty of employees who appeared loyal. These assumptions proved fatal. The bank itself represented British financial aristocracy in its purest form. Founded in 1762 by Francis Baring, a German immigrant's son, the institution financed the Louisiana Purchase for the United States government in 1803. Barings underwrote British government bonds during the Napoleonic Wars. Queen Elizabeth II maintained accounts there. The bank survived the 1890 panic, economic depressions, 2 world wars, and countless market crashes. Its reputation rested on conservative practices, careful risk assessment, and relationships spanning generations of elite British families. By the 1990s, this conservative reputation created dangerous complacency. Barings executives believed their institutional knowledge and aristocratic networks provided inherent protection against catastrophic failure. They entered derivative markets, complex, fast-moving, and requiring sophisticated risk management, while maintaining Victorian-era oversight structures. The board of directors met quarterly. Risk committees reviewed summary reports prepared by the very traders they were supposed to monitor. Internal audit departments operated with minimal staff and faced resistance when questioning senior traders' activities. Leeson joined this world in 1989, hired initially to work in Barings' settlements office processing paperwork for trades executed in London. He demonstrated meticulous attention to detail, working long hours resolving discrepancies other clerks ignored. When Barings established a Singapore office to trade futures contracts on the Singapore International Monetary Exchange, managers remembered Leeson's diligence. They needed someone who understood both trading mechanics and back-office settlement procedures. Leeson fit perfectly. Nobody questioned whether combining these roles, trader and settlement supervisor, violated fundamental banking controls that separate execution from verification. He arrived in Singapore in 1992, tasked with building Barings' presence in Asian derivative markets. The strategy seemed straightforward. Execute arbitrage trades, exploiting tiny price differences between contracts listed on Singapore and Osaka exchanges. Risk was theoretically minimal. Barings would buy contracts in one market, simultaneously sell identical contracts in the other market, and pocket the price differential. These trades required no directional bets on market movements, no speculation, no substantial risk exposure. Within months, Leeson reported consistent profits. His 1992 performance generated approximately £10 million, roughly half of Barings' entire futures division revenue. Executives in London celebrated. Here was proof that aggressive expansion into Asian markets delivered results. They increased his trading authority, raised his bonuses, and featured him in internal communications as a model employee. Nobody asked the obvious question: how was a junior trader with limited experience consistently outperforming seasoned professionals in one of the world's most competitive markets? The answer lay in account 8888. Leeson had created this error account shortly after arriving in Singapore, ostensibly to temporarily hold trades executed incorrectly by junior staff members. Such accounts were common in trading operations, providing a holding space for resolving mistakes before they appeared in official records. But Leeson repurposed his error account. Every genuine trading loss got reclassified into 88888. Every failed speculation disappeared into this hidden ledger. His official trading account showed only profits. The error account accumulated catastrophic losses that Barings' London headquarters never saw, because Leeson controlled both trading execution, the reporting systems that should have flagged his activities. Understanding this requires examining how Barings' organizational structure functioned. In properly managed financial institutions, traders execute transactions while separate back-office teams verify these trades, reconcile accounts, and report positions to senior management. This separation prevents exactly the kind of fraud Leeson committed. But Barings appointed Leeson as both head trader and settlement supervisor in Singapore. He executed trades and verified his own transactions. He reported his own positions to London. He reconciled his own accounts. The organizational chart literally enabled fraud by design. Senior executives later claimed they didn't understand these control weaknesses. This explanation strains credibility. Basic banking textbooks warn against combining trading and settlements functions. Regulatory guidelines explicitly prohibit this structure. Barings' own internal audit department flagged these concerns in reports that management apparently ignored. The truth was simpler and more damning. Barings' executives didn't want to question their star performer. Leeson generated profits. Questioning his methods risked disrupting a lucrative operation. So they didn't question, they didn't verify, they didn't investigate. They simply collected the reported profits and distributed bonuses while the real losses multiplied in an account they never examined. Humble beginnings. Nicholas Leeson's path to Barings began in circumstances that made his eventual position improbable. Born February 25, 1967, in Watford, Hertfordshire, he grew up in a working-class family where financial security meant steady employment, not wealth accumulation. His father worked manual labor jobs. The family lived in council housing, government-subsidized apartments for low-income residents. Leeson attended ordinary state schools, achieving unremarkable academic results. He left formal education at 18, entering the workforce without university credentials that typically served as prerequisites for banking careers. His first position at Coutts & Company, a private bank serving wealthy clients, placed him in back-office operations processing routine paperwork. He filed documents, reconciled accounts, and handled administrative tasks invisible to the executives making strategic decisions. The work demanded accuracy and attention to detail, but offered limited advancement opportunities for someone without elite educational background or family connections to upper management. Yet Leeson approached these mundane responsibilities with unusual intensity. Colleagues remembered him staying late to resolve discrepancies others would simply carry forward to the next day. When computer systems showed mismatches between trade records and settlement accounts, Leeson tracked down the sources systematically, often finding errors that had persisted for weeks because nobody else bothered investigating. This diligence attracted attention from managers seeking reliable staff for specialized projects. In 1989, Barings recruited him to join their settlements office in London. The timing proved significant. Barings was expanding derivative trading operations, entering markets that required processing thousands of futures contracts daily. These instruments, agreements to buy or sell assets at specified future dates, generated complex paperwork trails that overwhelmed clerks unfamiliar with their mechanics. Leeson's previous experience processing trades made him valuable. He understood how trades flowed from execution through settlement, how errors emerged, and how to reconcile discrepancies efficiently. His initial work at Barings focused on cleaning up back-office chaos in Jakarta, Indonesia, where the bank's fledgling futures operation had accumulated mounting settlement failures. Leeson spent weeks untangling disputed trades, recovering funds trapped in reconciliation problems, and establishing systematic procedures for processing confirmations. He succeeded, resolving issues that more senior employees had declared intractable. Barings executives took notice. Here was someone who delivered results in challenging circumstances, someone reliable, hard-working, and apparently content with the grinding operational work that traders considered beneath their attention. This combination, operational expertise plus willingness to work long hours in unglamorous roles, made Leeson attractive when Barings needed someone to establish their Singapore trading office in 1992. The bank wanted to capitalize on growing Asian derivative markets, specifically arbitrage opportunities between contracts listed on Singapore International Monetary Exchange and Osaka Securities Exchange. These trades theoretically offered low-risk profits by exploiting tiny price differences between identical contracts traded in different markets. Success required flawless execution and settlement, precisely Leeson's demonstrated strengths. Barings appointed him head of floor trading and settlement supervisor for the Singapore office. The dual role violated fundamental controls separating trading from verification, but executives viewed it as practical efficiency. Singapore was a small operation, initially just a handful of staff. Separating these functions would require hiring additional personnel, increasing costs for an experimental venture. Leeson had proven trustworthy. He understood both trading mechanics and back-office procedures. Why not consolidate responsibilities? This decision reflected deeper institutional assumptions about trust and class within Barings. The bank's traditional model relied on gentlemen's agreements among aristocratic families who had known each other for generations. Traders from these families required minimal oversight because their social standing guaranteed honorable behavior. Leeson came from outside this world, but his demonstrated loyalty and work ethic seemingly offered equivalent guarantee. Nobody considered that operational skills plus unsupervised authority might enable rather than prevent fraud. Leeson arrived in Singapore in April 1992, age 25, suddenly responsible for millions in daily trading volume. The office occupied space on the Singapore International Monetary Exchange floor, where brokers shouted orders in trading pits using hand signals that looked like controlled chaos to outsiders. Electronic trading was still emerging. Most futures transactions still happened through open outcry, with traders physically present in designated pits corresponding to different contract types. Barings' strategy focused on Nikkei 225 futures, contracts based on Japan's main stock index. The same contracts traded on both Singapore and Osaka exchanges. Price differences between these markets created arbitrage opportunities. If Nikkei futures traded at 19,000 in Singapore and 19,020 in Osaka, a trader could simultaneously buy in Singapore and sell in Osaka, locking in a 20-point profit with theoretically zero risk because the contracts represented identical underlying assets. Leeson executed these trades competently. His first months generated legitimate profits from genuine arbitrage opportunities. But he also began trading speculatively, making directional bets that Nikkei futures prices would move in specific directions. These bets violated Barings' strategy. Arbitrage trading required no market predictions. It simply exploited price inefficiencies. Speculation meant risking capital on predictions about future market movements. When Leeson's speculative trades generated losses, he faced a choice: report the losses to London headquarters and face questions about his strategy, or hide the losses and hope to recover them with subsequent successful trades. He chose concealment. Using his settlement supervisor authority, Leeson created account 88888 in Barings' internal systems. He designated it an error account, supposedly for temporarily holding trades executed incorrectly until they could be properly allocated or cancelled. Such accounts existed in most trading operations as administrative tools. Nobody in London questioned another error account appearing in Singapore's books. But Leeson used 8888 differently. Profitable trades appeared in his official accounts reported to London. Losing trades got reclassified into the hidden error account. London saw only profits. The error account accumulated growing losses that Leeson convinced himself he would eventually recover through successful future trades. This rationalization, common among fraudsters, transformed a temporary deception into an accelerating catastrophe. Each loss increased pressure to take bigger risks, attempting recovery. Each bigger risk generated larger potential losses. The cycle became self-reinforcing, driving Leeson toward increasingly desperate gambles. By year-end 1992, account 88888 held approximately £2 million in concealed losses. Simultaneously, Leeson's official accounts showed £10 million in profits, making him Barings star Asian trader. London executives celebrated his performance. They increased his trading limits, authorized larger positions, and discussed promoting him to more senior responsibilities. Nobody audited the Singapore office's complete accounting records. Nobody verified that reported profits corresponded to actual cash positions. Nobody questioned how a 25-year-old with minimal experience consistently outperformed seasoned professionals. The trust that made Barings' aristocratic model function for centuries now enabled its destruction. Singapore assignment. Leeson's Singapore operation occupied a unique position within Barings' organizational structure. London executives viewed it as a profitable expansion into growing Asian markets. Regulators saw it as a properly licensed broker-dealer operating under Singapore Monetary Authority oversight. The Singapore International Monetary Exchange recognized Barings Futures Singapore as a member firm entitled to trade on their systems. Each perspective was technically accurate. None captured the complete reality. Leeson was running an increasingly reckless proprietary trading operation disguised as conservative arbitrage. The official strategy remained straightforward. Barings Futures Singapore would execute arbitrage trades exploiting price differences between Nikkei 225 futures contracts listed on Simex and Osaka Securities Exchange. These contracts represented identical assets, options to buy or sell Japan's Nikkei stock index at specified future dates. Prices should theoretically match between exchanges, but brief discrepancies emerged due to timing differences, liquidity variations, and trader behavior. A disciplined arbitrage operation could capture these tiny differentials repeatedly, generating steady low-risk profits. Leeson understood this strategy. His early 1992 trades followed the arbitrage model correctly. He identified price gaps, executed simultaneous buy and sell orders on the two exchanges, and closed positions once the prices converged. These trades generated modest but consistent returns. Barings risk managers in London reviewed monthly summaries showing appropriate hedged positions with minimal directional exposure. Everything appeared proper, but Leeson simultaneously operated a completely different trading strategy invisible to London. He was making massive unhedged directional bets that Japanese stock markets would remain stable or rise gradually. These trades violated every principle of the arbitrage strategy Barings authorized. Instead of hedging positions by holding offsetting contracts on different exchanges, Leeson held enormous one-sided positions betting that Nikkei futures prices wouldn't fall significantly. The mechanics were deceptively simple. Leeson sold options, contracts giving buyers the right to sell Nikkei futures at specified prices. By selling these put options, Leeson collected immediate premiums from buyers seeking insurance against market declines. If markets remained stable or rose, the options would expire worthless, and Leeson would keep the premiums as profit. But if markets fell sharply, option buyers would exercise their contracts, forcing Leeson to purchase futures at prices above current market value. The potential losses were theoretically unlimited. This strategy is called selling naked options, selling insurance without holding offsetting positions that would limit losses if the insured event occurs. Professional traders avoid this strategy because while it generates consistent small premiums, it risks catastrophic losses during market downturns. Leeson embraced it because the premium income helped offset losses accumulating in account 88888. Each month he sold more options, collected more premiums, and reported these premiums to London as arbitrage profits. London executives saw consistent monthly gains averaging several £1,000,000. They didn't question the remarkable consistency because Leeson's official reports showed fully hedged positions with minimal risk. The reports were fabricated. Leeson's settlement supervisor authority let him generate whatever documentation London expected. He created fictional trades supposedly executed on Osaka Exchange to hedge his Singapore positions. These Osaka trades never actually occurred. The hedge positions existed only in fraudulent paperwork that nobody in London independently verified. This fraud required Leeson to exploit specific structural weaknesses in Barings' oversight. First, London management didn't understand futures trading mechanics sufficiently to recognize impossible patterns. When Leeson reported consistent profits from arbitrage that theoretically offered tiny spreads, nobody questioned how he was achieving returns that implied arbitrage spreads far larger than market data suggested existed. Second, Barings maintained no independent price verification. They relied on Leeson's reports showing prices at which trades supposedly executed. Nobody checked whether these prices matched actual market prices on the relevant dates. Third, Barings' internal audit department lacked authority to demand complete trading records from Singapore. When auditors requested documentation, Leeson provided carefully selected summaries that concealed his actual positions. The organizational dysfunction extended beyond Barings internally. The Singapore Monetary Authority and CIMEX regulators also failed to detect Leeson's activities despite having independent access to trade data. Regulatory oversight focused on ensuring adequate margin deposits to cover potential losses. Margin requirements functioned as safety deposits. Traders posted cash or securities with exchanges to guarantee they could fulfill contract obligations. As Leeson's positions grew, margin requirements increased proportionally. Here Leeson faced a concrete constraint. He couldn't fabricate margin payments. CIMEX demanded actual cash transfers to cover his massive positions. The amounts were staggering. By late 1993, Barings was funding over £100 million in margin for positions that London believed were fully hedged arbitrage trades requiring minimal margin. Nobody in London asked why supposedly hedged positions required such enormous margin funding. Leeson explained it as temporary operational requirements due to settlement timing differences. Finance staff transferred the requested funds without independently verifying the explanation. This margin funding revealed perhaps the most damning institutional failure. Barings' Treasury Department in London sent hundreds of millions of pounds to Singapore based solely on Leeson's requests, with no independent confirmation that these funds supported legitimate trading activities. The amount of margin required was itself evidence of enormous unhedged positions. A properly hedged arbitrage operation shouldn't require massive margin, because gains in one market offset losses in another. But Barings' finance executives apparently didn't understand this principle, or chose not to question their star trader. Leeson's reported 1993 performance showed approximately £28 million in profits, roughly 20% of Barings' total firm-wide earnings. London executives celebrated, awarding him substantial bonuses and increased trading authority. Chairman Peter Baring personally praised Leeson's contributions during internal meetings. Risk committee reviews noted Singapore's strong performance but raised no concerns about the trading strategy or position sizes. Behind this success, Account 88888 held approximately £23 million in accumulated losses by year-end 1993. Leeson had generated £28 million in genuine profits from arbitrage and option premiums, while simultaneously losing £23 million through failed speculation. The net was still positive, but the trajectory was unsustainable. His position sizes were growing, the hidden losses were accelerating, and he was increasingly reliant on market stability to avoid catastrophic losses from his massive short option positions. The specific market risk was straightforward. Leeson had sold thousands of Nikkei put options with strike prices around 19,000. As long as the Nikkei index remained above this level, the options would expire worthless. But if the index fell below 19,000, option buyers would exercise their contracts, forcing Leeson to purchase futures at 19,000 while market prices were lower. A decline to 18,000 would generate losses exceeding £100 million. A decline to 17,000 would destroy Barings completely. Professional risk managers would have immediately recognized this exposure and demanded position reductions. Barings' risk managers in London never saw Leeson's actual positions. They reviewed fabricated reports showing hedged arbitrage trades. When market data from CIMEX showed Barings Futures Singapore holding enormous open positions, risk managers assumed these were client positions or fully hedged proprietary trades. Nobody verified these assumptions. Nobody demanded complete position reports directly from CIMEX rather than relying on Leeson's summaries. Nobody calculated potential losses if markets moved adversely. This institutional blindness wasn't accidental. Barings' culture discouraged skeptical questioning of successful traders. Leeson generated profits. Questioning his methods risked appearing ignorant of sophisticated trading strategies. Senior executives lacked deep understanding of derivative mechanics themselves, making them reluctant to challenge explanations from someone who appeared expert. And Barings' aristocratic traditions emphasized trust over verification, relationships over systematic controls. The result was an organization structurally incapable of detecting fraud that competent oversight would have identified within weeks. Leeson didn't use sophisticated techniques. He used basic accounting manipulation that any independent audit would expose immediately. But Barings' audit processes relied on trader cooperation rather than independent verification. When Leeson claimed trades were executed at specific prices, auditors accepted these claims. When he explained margin requirements as operational necessities, finance staff transferred funds. When he reported consistent profits from arbitrage, risk managers celebrated without verifying the underlying positions. Hidden losses. By early 1994, Leeson's fraud had become self-perpetuating. Each month's concealed losses increased pressure to generate offsetting profits through increasingly risky trades. Each risky trade amplified potential future losses. The cycle accelerated because Leeson couldn't reduce his positions without realizing losses that would expose the fraud immediately. His only options were maintaining current positions hoping for favorable market movements, or increasing positions attempting to trade his way back to profitability. He chose escalation. Throughout 1994, Leeson's trading volume and position sizes grew exponentially. By mid-year, Barings Futures Singapore accounted for approximately 40% of all open interest in Nikkei futures contracts on CMEX, an absurd concentration for what was supposedly a small arbitrage operation. Other market participants noticed. Competitors assumed Barings was executing trades for major clients, perhaps Japanese institutional investors seeking exposure through Singapore markets. Some traders suspected Barings was running proprietary positions, but assumed London headquarters was deliberately employing aggressive strategies in Asian markets. Nobody suspected a single rogue trader had accumulated positions large enough to move markets. The scale seemed impossible. Barings was a mid-sized merchant bank with approximately £400 million in capital. Leeson's positions represented multiples of the entire firm's net worth. How could London management allow such concentration? The question answered itself. They couldn't and wouldn't, so the positions must be either client trades or properly hedged proprietary positions. This logical reasoning prevented competitors and regulators from recognizing the truth. Leeson's daily routine involved managing these massive positions while fabricating reports that concealed their existence. Mornings began with reviewing overnight market movements in Japanese equity markets. Nikkei futures prices tracked the underlying Nikkei 225 stock index, which traded on Tokyo Stock Exchange during Japanese business hours. Significant moves in Tokyo would affect Singapore futures prices when markets opened. Leeson needed to assess potential impacts on his option positions and plan the day's trading accordingly. The Singapore trading floor operated from roughly 8 a.m. to 7 p.m. local time, overlapping with both Japanese and European trading hours. Leeson spent these hours executing trades, managing positions and maintaining the appearance of normal arbitrage operations. He actually executed legitimate arbitrage trades to generate genuine profits that helped offset hidden losses. He simultaneously managed his massive short option positions, buying or selling additional contracts to adjust his exposure as market prices moved. Afternoons involved generating paperwork. Leeson needed to create fictional documentation, showing hedged positions to send to London, while maintaining accurate internal records of his actual positions for managing the next day's trading. This required meticulous attention to detail. One documentation error could expose discrepancies that alert auditors would investigate. Leeson's back-office experience proved crucial. He understood exactly what documentation London expected, what trade confirmations should look like, and what account reconciliations would satisfy compliance reviews. Evenings brought additional pressure. As London business hours began, Singapore being 7 or 8 hours ahead depending on daylight savings, Leeson faced inquiries from headquarters about margin requirements, position sizes, and trading strategies. He crafted responses designed to provide reassurance without revealing actual positions. When risk managers questioned unusually large margin calls, Leeson explained them as temporary requirements due to client trading activity or settlement timing. When finance executives asked about cash flow patterns, he attributed them to operational necessities of futures trading. These explanations worked because Barings executives wanted them to work. Leeson generated approximately half of Barings' entire derivative trading profits. Challenging his activities risked disrupting this lucrative operation. Senior management had careers and compensation tied to Barings' performance. Singapore's reported profits supported bonuses, stock prices, and executive reputations. Nobody had incentive to investigate too carefully. Internal audit did raise concerns. In July 1994, Barings' audit department completed a review of Singapore operations that identified significant control weaknesses. The report specifically noted that Leeson's dual role as head trader and settlement supervisor violated fundamental control principles. It recommended immediately separating these functions, appointing an independent settlements manager who would report to London rather than Leeson. The report also questioned whether reported arbitrage profits were consistent with observed market conditions and recommended independent verification of Singapore's positions. Management's response was telling. They acknowledged the concerns but took no corrective action. Minutes from subsequent executive committee meetings show that Chairman Peter Baring and other senior executives discussed the audit findings but decided that restructuring Singapore's operation would be disruptive to a profitable business. They instructed Leeson to develop plans for eventually separating trading and settlements functions, but set no deadline for implementation. They requested additional documentation about trading strategies, but accepted Leeson's explanations without independent verification. This decision sealed Baring's fate. Had management acted on the audit recommendations in mid-1994, separating Leeson's roles and independently verifying positions, they would have discovered losses that were still potentially manageable at approximately £50 million. Barings could have survived a £50 million write-off, though it would have severely damaged the firm's reputation and ended careers. Instead, they allowed Leeson to continue operating without meaningful oversight for another 8 months while losses accelerated toward £1 billion. The hidden losses lived in account 88888, which by September 1994 showed approximately £150 million in accumulated deficits. These losses represented actual cash that Barings had transferred to Singapore as margin payments, but that had disappeared into trading losses. The money was gone, consumed by market movements adverse to Leeson's positions. But Barings' books showed these funds as assets, margin deposits supposedly securing profitable trading positions. The discrepancy between reported assets and actual reality approached amounts that would wipe out significant portions of Barings' capital base. Leeson needed market stability to survive. His short option positions would remain profitable only if the Nikkei index stayed relatively flat. Through late 1994, Japanese markets cooperated, trading in a narrow range around 19,000 points. Leeson's options expired worthless as hoped, generating premium income that offset some hidden losses, but the risk accumulated with each passing month. His position sizes kept growing. By year-end 1994, a 1000-point move in the Nikkei would generate losses exceeding £100 million. A 2000-point move would destroy Barings. Financial markets don't accommodate traders' needs. On January 17, 1995, an earthquake struck Kobe, Japan, killing over 6,000 people and causing massive economic disruption. Japanese stock markets plunged as investors assessed the disaster's economic impact. The Nikkei index fell approximately 1,000 points in the days following the earthquake. Leeson's short option positions generated instant losses exceeding £60 million. Combined with previous hidden losses, account 8888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888888 he began buying Nikkei futures in massive quantities, attempting to support market prices through sheer purchasing volume. The strategy was insane, one trader trying to prop up an entire stock market index through futures purchases. But Leeson had no alternative. Admitting losses meant prison. His only hope was that markets would recover. His long futures positions would generate profits, and he could somehow recover enough to cover the hidden deficits. The buying accelerated through late January and early February. Leeson purchased thousands of Nikkei futures contracts daily, becoming one of the largest single buyers in these markets. Other traders noticed the unusual activity. Some speculated Barings was executing a massive client order. Others assumed London was making a major proprietary bet on Japanese market recovery. Nobody suspected a desperate trader attempting to manipulate markets to cover fraud. The purchases required enormous margin payments. Cymex demanded cash to secure these positions. Leeson requested hundreds of millions from London, explaining them as necessary margin for increased client trading activity. Barings' Treasury Department transferred the funds based on Leeson's requests, apparently without verifying that client trading actually existed. Between late January and late February 1995, Barings sent over £700 million to Singapore, an amount exceeding the firm's entire capital base. This staggering cash transfer should have triggered immediate investigation. No legitimate trading operation requires margin exceeding a firm's total capital unless positions have grown completely out of control. But Barings' finance executives continued funding these requests. Either they didn't understand the implications, or they chose not to question activities they should have recognized as obviously abnormal. Desperate Gambles, February 1995, marked Leeson's final descent from concealment to desperation. The Kobe earthquake's market impact had transformed manageable hidden losses into catastrophic deficits. His response, buying massive quantities of Nikkei futures attempting to support prices, reflected not strategy but panic. Professional traders recognize when positions become unrecoverable and implement damage control. Leeson couldn't afford damage control. Any position reduction would realize losses that would immediately expose the fraud and destroy Barings. His trading during these final weeks displayed both the scale of his positions and the futility of his strategy. On some days, Barings Futures Singapore accounted for over 50% of total trading volume in Nikkei futures on Simex. Leeson was buying every available contract, pushing prices higher temporarily through sheer purchasing power. Other market participants noticed the distortion. Traders began taking the opposite side of Barings' positions, selling futures to Leeson at elevated prices and waiting for the inevitable collapse when his buying pressure ended. This created a perverse dynamic. Leeson's buying temporarily supported prices, preventing immediate catastrophic losses, but each purchase required additional margin, forcing him to request more funds from London. And the temporary price support was unsustainable. Eventually his buying would stop, prices would fall, and his losses would crystallize. He was essentially delaying the inevitable while making the final outcome worse with each passing day. The margin calls reached absurd levels. By mid-February, Barings had transferred over £400 million to Singapore in less than 3 weeks. Treasury staff in London raised questions about these enormous transfers. Finance executives asked Leeson for detailed explanations. His responses were creative fiction. He claimed margin requirements reflected high-volume client trading in volatile markets. He attributed increased activity to institutional investors rebalancing portfolios after the earthquake. He suggested that temporary funding needs would reverse once markets stabilized and positions matured. These explanations didn't withstand basic scrutiny. Barings' reported client base in Singapore was relatively small. The margin being transferred exceeded reasonable requirements for those clients by orders of magnitude. But London executives accepted the explanations because the alternative, acknowledging that something was catastrophically wrong, would force immediate action that would expose their oversight failures. Institutional incentives favored believing comfortable lies over investigating uncomfortable truths. Leeson's personal situation deteriorated along with his trading positions. His wife Lisa, who had joined him in Singapore, grew increasingly concerned about his behavior. He worked constantly, arriving at the office before dawn and leaving after midnight. He appeared stressed, withdrawn, and defensive when she asked about work. She didn't understand the specifics but recognized something was seriously wrong. Colleagues noticed similar changes. Leeson became short-tempered with staff members asking questions about trades or account reconciliations. He restricted access to certain computer systems that tracked account 888888, claiming operational reasons. When Singapore office employees mentioned irregularities to visiting London executives, Leeson dismissed these concerns as reflecting junior staff confusion about complex trading strategies. The pressure manifested physically. Leeson developed stomach problems that doctors attributed to stress-related ulcers. He slept poorly, often lying awake calculating potential losses if markets moved adversely. He began drinking heavily after work, attempting to manage anxiety that became overwhelming. Friends from his early Barings days barely recognized him when they encountered him during visits to Singapore. The confident young trader who'd arrived 3 years earlier had become haggard, defensive, and visibly unwell. Yet he continued trading, driven by a combination of hope and fear that prevented rational assessment of his situation. Hope that markets would somehow recover enough to allow him to reduce positions and cover losses before anyone discovered the fraud. Fear that stopping would guarantee discovery, disgrace, and prison. This psychological trap is common among fraudsters who convince themselves that the next trade will solve everything, that one lucky break will make past problems disappear. Market reality refused cooperation. Through mid-February, the Nikkei traded in a range that generated neither the sharp recovery Leeson needed nor the complete collapse that would end the charade immediately. Prices fluctuated around 18,000, 19,000, well below the levels where Leeson's option positions would profit but not low enough to trigger total catastrophe. Each day extended the agony, piling additional losses onto positions that were already mathematically unrecoverable. By February 23rd, account 88888 showed losses exceeding £800 million. Leeson's long futures positions, purchased in desperate attempts to support prices, added approximately £400 million in additional potential losses if markets fell further. Combined exposure approached £1.2 billion, nearly 3 times Barings' entire capital. The firm was technically insolvent. Its liabilities exceeded its assets by amounts that would require closing the bank if discovered. That evening, Leeson finally acknowledged the inevitable. He couldn't recover these losses. No trading strategy could generate enough profit to cover £1.2 billion in deficits. Markets wouldn't cooperate by rallying thousands of points to salvage his positions. The fraud was going to be discovered. The only remaining questions were when and how. He spent hours that night composing a letter to his superiors in London. The final version was remarkably brief, offering no excuses or explanations. My sincere apologies for the predicament that I have left you in. It was neither my intention nor aim for this to happen, but the pressures, both business and personal, have become too much to bear, and after receiving medical advice, have affected my health to the extent that a breakdown is imminent. I tender my resignation with immediate effect. The letter avoided specifics about losses, positions, or the fraud's mechanics. Leeson couldn't bring himself to detail the catastrophe fully. The apology was sincere. He genuinely regretted destroying the institution that had given him opportunities far beyond his background. But sincerity couldn't repair the damage or restore £1.2 billion that had vanished into failed trades. On Friday, February 24th, Leeson left the letter on his desk at Barings' Singapore office. He and his wife boarded a flight to Kuala Lumpur, beginning a brief flight from authorities that would end days later in Frankfurt. As his plane departed Singapore, markets in Tokyo were opening for Friday trading. The Nikkei would fall another 300 points that day, adding £50 million to Leeson's losses. By the time London executives discovered his letter and began investigating, the total deficit would exceed £850 million, an amount that made Barings' collapse inevitable regardless of any rescue attempts. Systems breakdown. Leeson's resignation letter reached London headquarters Saturday morning, February 25th. The timing was deliberate. Saturday meant skeleton staff presence, delaying immediate investigation. But when Treasury executives reviewed the week's margin transfers and began cross-checking against reported trading positions, panic set in quickly. The amounts didn't reconcile. Barings had transferred over £700 million to Singapore in recent weeks, supposedly as margin for hedged arbitrage trades. But hedged positions shouldn't require such massive margin. Something was catastrophically wrong. Senior executives convened emergency meetings Saturday afternoon. Chairman Peter Baring assembled the bank's leadership team, including Head of Trading Ron Baker, Finance Director Tony Hawes, and several risk management officials. Initial assessment focused on understanding basic facts. What positions did Singapore actually hold? What were the potential losses? Could the situation be contained? The answers came slowly, revealing institutional dysfunction at every level. Nobody in London knew Singapore's actual positions. The reports Leeson had provided showed modest hedged arbitrage trades. But Cymex records, which executives now access directly for the first time, showed enormous unhedged long positions in Nikkei futures. Barings Futures Singapore held over 60,000 contracts, a position so large it represented roughly 50% of all open interest in these instruments on Cymex. Risk managers began calculating potential losses. If markets opened Monday unchanged, Barings faced losses exceeding £200 million from Leeson's known futures positions. But these calculations excluded options, which remained invisible because Leeson had never properly reported them to London. As accountants dug through Singapore's trading records, they discovered thousands of sold options that represented unlimited loss potential if markets fell further. The scale overwhelmed standard risk management frameworks. Barings' entire capital base was approximately £400 million. The bank faced positions generating potential losses of several times its total capital. No amount of hedging or position adjustment could mitigate exposure this massive over a weekend. When Asian markets opened Monday morning, Barings would either need to close positions immediately, accepting catastrophic losses, or maintain positions hoping markets would move favorably. Neither option was viable. Closing positions would require selling 60,000 Nikkei futures contracts into falling markets, driving prices even lower and increasing losses with each sale. The selling pressure alone would likely trigger market circuit breakers that suspend trading, leaving Barings unable to exit positions. Maintaining positions meant gambling the firm's survival on market movements nobody could predict or control. Finance executives faced a parallel crisis. Barings owed Cymex over £400 million in margin payments for Monday morning. The exchange would demand this margin when markets opened. If Barings couldn't pay, Cymex would liquidate positions immediately, crystallizing whatever losses existed at that moment. But paying margin required cash the firm didn't have readily available. Barings would need either to liquidate assets quickly or secure emergency funding from the Bank of England. Saturday evening, Chairman Peter Baring contacted Bank of England officials to explain the situation. The conversation was awkward, requiring him to admit that his firm had lost control of a Singapore trader who had accumulated positions exceeding Baring's total capital without London management's knowledge. Bank of England Governor Eddie George listened, asked pointed questions about oversight failures, and promised to assess rescue options overnight. By Sunday morning, fuller picture emerged of how completely Barings' control systems had failed. Internal audit reports from previous years had flagged concerns about Leeson's dual role as trader and settlement supervisor. Management had acknowledged these concerns but taken no corrective action. Risk management systems had focused on reviewing Leeson's self-reported positions rather than independently verifying actual holdings. Finance department had transferred hundreds of millions based on Leeson's margin requests without independently confirming the underlying trades existed. Every control that should have prevented or detected the fraud had failed. Segregation of duties, violated by Leeson's dual role. Independent verification, absent because London relied on Singapore's self-reporting. Management oversight, inadequate because executives lacked understanding of derivative risks. Audit effectiveness, ignored because management didn't implement audit recommendations. Regulatory supervision, fooled by Leeson's fabricated reports. This wasn't one control failure. It was systemic institutional breakdown spanning every function that existed to prevent exactly this scenario. And the breakdown wasn't accidental. It reflected conscious management decisions to prioritize profits over controls, to trust employees over verification systems, and to avoid difficult questions that might disrupt lucrative operations. Bank of England officials recognized these failures during Sunday discussions about potential rescue. Governor George's assessment was blunt. Barings had brought this disaster on itself through negligent management. Why should British taxpayers fund a bailout for a bank that had ignored basic risk controls? But George also understood the systemic implications. Barings' collapse could trigger contagion affecting other British financial institutions and potentially destabilizing international markets. Sunday afternoon, Bank of England convened a meeting with major British banks to explore rescue options. Could a consortium of banks acquire Barings, assuming its derivative positions and stabilizing markets? The proposition was unattractive. Potential acquirers would inherit not just £800 million in known losses, but also Leeson's option positions, whose final cost remained unknown. And they would associate their reputations with a fraud scandal that would attract intense regulatory scrutiny and potential legal liability. Bank representatives asked technical questions about Barings' positions, attempting to assess whether some hedging strategy might limit losses. Risk analysts delivered bad news. The positions were too large and one-sided to hedge effectively. Any attempt to reduce exposure would move markets adversely, increasing losses. The only hope was that markets would stabilize or recover, allowing gradual position reductions over weeks or months. But this required maintaining Barings as a going concern, funding margin payments indefinitely, and gambling on market cooperation. By late Sunday evening, consensus emerged that rescue was impractical. No consortium would accept open-ended losses from positions they couldn't control. Bank of England wouldn't commit taxpayer funds to bail out private shareholders whose management had enabled the fraud. Barings would enter bankruptcy administration Monday morning. Its positions would be liquidated as markets allowed. Losses would fall on shareholders, creditors, and the firm's partners who bore unlimited liability under Barings' traditional partnership structure. The decision meant the end of a 233-year-old institution. Partners who had inherited Barings stakes from ancestors who had founded the bank would lose everything. Employees worldwide would lose jobs through no fault of their own. Clients would face uncertainty about their accounts and securities held at Barings. And British finance would confront embarrassing questions about how regulators had failed to prevent such massive fraud at a prestigious institution. Final collapse. Collapse. Final Monday, February 27th, began with emergency announcements. Before Asian markets opened, Bank of England issued statements confirming that Barings would enter administration due to unauthorized trading losses. The bank provided no specific loss amounts, hoping to minimize market panic, but traders immediately understood the implications. Unauthorized losses large enough to destroy Barings meant positions that would need liquidation, creating selling pressure that would drive markets lower. Asian markets opened with heavy selling. The Nikkei fell over 300 points in morning trading as investors anticipated liquidation of Barings' massive long positions. Other holders of Japanese equity positions sold preemptively, trying to exit before Barings' forced selling drove prices lower. The dynamic became self-fulfilling. Fear of Barings' liquidation caused selling that justified the fear, creating downward spiral that increased the losses Barings would ultimately realize. CIMEX officials faced impossible choices. Exchange rules required them to liquidate Barings' positions to protect other market participants. But selling 60,000 futures contracts immediately would overwhelm available buyers and crash prices. They needed to liquidate gradually, selling into whatever buying interest existed without triggering panic. Yet gradual liquidation meant accepting losses that would grow if markets continued falling. Administrators from Coopers and Lybrand accounting firm took control of Barings' operations Monday morning. Their mandate was maximizing recovery for creditors by selling assets and closing positions in orderly fashion. The derivative positions in Singapore were the critical issue. Administrators needed to understand exactly what Leeson had traded, calculate potential losses, and develop liquidation strategy. The investigation revealed problems beyond even Sunday's worst estimates. When administrators accessed account 888888 directly, they discovered options positions Leeson had never reported to London. He had sold thousands of put and call options across various strike prices and expiration dates. These positions were currently generating losses, but their final cost depended on market movements over coming weeks as options reached expiration. Calculating precise exposure required sophisticated modeling. Administrators brought in derivative specialists to analyze the options portfolio and estimate potential outcomes under different market scenarios. The analysis was sobering. If markets stabilized, losses might total £600 million. If markets continued falling, losses could exceed £1 billion. If markets crashed, losses might reach £1.3 billion or more. These amounts dwarfed Barings' £400 million capital base by multiples. The bank was deeply insolvent. Even in best-case scenarios, losses would consume all shareholder equity plus significant creditor funds. Partners facing unlimited liability would lose their entire personal wealth and potentially still owe additional amounts to creditors. Public reaction combined shock and anger. Barings had financed the Louisiana Purchase in 1803, supported British government throughout the Napoleonic Wars, and served as banker to the Queen. How could such an institution collapse due to one trader? Media coverage focused on Leeson, portraying him as a rogue criminal who had destroyed a pillar of British finance. But more thoughtful analysis questioned how management had failed to detect fraud that violated basic banking principles. Regulatory investigations began immediately. Britain's Securities and Investments Board launched formal inquiry into whether Barings had violated financial services regulations. Singapore Monetary Authority initiated parallel investigation of whether Barings Futures Singapore had breached local rules. Both inquiries would ultimately conclude that management failures, not just Leeson's fraud, had caused the collapse. The human cost extended far beyond senior executives. Barings employed approximately 1,200 people globally. Most were administrative staff, traders, or investment bankers who had no connection to Singapore operations. Monday's administration announcement meant most would lose jobs. Their pension funds, largely invested in Barings stock, would become nearly worthless. Years of accumulated retirement savings evaporated in hours. Clients faced uncertainty about securities and cash held at Barings. Most retail brokerage accounts were protected by investor insurance schemes, but recovery would take months. Institutional clients with large positions faced potential losses if Barings' bankruptcy estate couldn't fully satisfy claims. The uncertainty triggered client withdrawals from other British merchant banks, as investors worried about broader contagion. Leeson himself remained missing. After fleeing Singapore Friday evening, he and his wife had traveled to Kuala Lumpur, then Brunei, attempting to stay ahead of authorities. But Interpol had issued international arrest warrant. Malaysian and British authorities tracked the couple's movements through hotel registrations and airline bookings. By Tuesday, they were located at a Frankfurt hotel. German police arrested Leeson Wednesday morning. He initially resisted extradition to Singapore, where he faced criminal fraud charges, preferring trial in Britain where sentences would likely be lighter. His lawyers argued that Singapore's criminal justice system was too harsh, potentially subjecting him to treatment that violated European human rights standards. The argument delayed extradition for several months but ultimately failed. Back in London, administrators worked to salvage whatever value remained from Barings' wreckage. The bank's traditional merchant banking operations, corporate finance advisory, asset management and private client services still had value to potential acquirers. These operations generated steady revenue and employed skilled professionals, but separating them from the Singapore disaster proved difficult. Any acquirer would face reputation damage from association with Barings' collapse. ING, a Dutch banking and insurance group, emerged as potential buyer. They offered to acquire Barings for symbolic payment of £1, assuming most liabilities, but excluding the Singapore derivative positions. The deal would save jobs and preserve client relationships, but would leave Barings' partners and shareholders with nothing. Partners debated whether accepting this humiliation was better than complete liquidation. Many were aristocrats whose families had controlled Barings for generations. Accepting ING's offer meant acknowledging their era had ended. By Thursday, March 2nd, loss estimates stabilized around £850 million, more than double Barings' capital. Administrators confirmed the bank was hopelessly insolvent. Partners approved ING's acquisition offer, understanding they had no alternative. The Barings name would survive as a subsidiary of ING, but the independent institution was finished. Global shockwave. Barings' collapse sent immediate shockwaves through international financial markets. If a prestigious 233-year-old institution could fail due to undetected fraud, what prevented similar collapses elsewhere? Banks worldwide faced intense scrutiny from regulators, demanding demonstration that controls existed to prevent rogue trading. The crisis triggered fundamental reassessment of derivative regulation. Through the 1990s, derivatives had grown explosively with minimal regulatory oversight. These complex instruments traded in largely unregulated markets, with firms self-reporting positions and risk exposures. Barings proved that self-reporting was inadequate. Firms would conceal problems until they became catastrophic. Regulatory responses varied globally. Britain's Securities and Investments Board launched comprehensive review of how financial firms manage derivative risks. They mandated separation of trading and settlement functions, required independent verification of positions, and strengthened capital requirements for firms operating in derivative markets. The regulations were essentially codifying controls that should have existed already: separation of duties, independent verification, adequate oversight. Singapore Monetary Authority faced particular pressure. Barings had collapsed while operating under Singapore's regulatory supervision. CIMEX had maintained oversight of Barings Futures Singapore and should have detected the excessive positions. The failures damaged Singapore's reputation as a well-regulated financial center and raised questions about whether Asian regulators could adequately supervise sophisticated international trading operations. Singapore's response was aggressive. They implemented mandatory real-time reporting of all derivative positions by exchange members. They required daily reconciliation of member firms' internal records against exchange clearing records. They established minimum capital requirements, specifically for firms engaging in derivative trading. Most significantly, they mandated that no individual could simultaneously control trading execution and back-office settlement, the precise structural failure that had enabled Leeson's fraud. Other jurisdictions followed. Japan strengthened oversight of futures exchanges. Germany revised banking laws to mandate better risk management. Even United States, which had avoided similar disasters, implemented new regulations requiring banks to establish independent risk management functions with authority to override traders and impose position limits. The intellectual impact extended beyond regulation. Academics studying financial risk management used Barings as a case study, demonstrating organizational failures in risk control. The collapse illustrated how cognitive biases, confirmation bias, trust in authority, reluctance to challenge success, could disable rational risk assessment. Business schools incorporated Barings into curriculum teaching corporate governance and internal controls. For financial practitioners, Barings became a cautionary tale about the dangers of opacity in complex trading. The case demonstrated that management couldn't rely on trust or trader reputation. They needed systematic verification, independent oversight, and willingness to challenge profitable operations. The lesson seemed obvious, yet firms continued trusting traders who generated consistent profits without adequately verifying their methods. The human story raised questions about individual responsibility versus institutional failure. Leeson clearly committed fraud, falsifying records and lying to superiors. He deserved prosecution and imprisonment. but his fraud succeeded only because Barings' management created conditions enabling it. They gave him unsupervised authority, they ignored audit warnings, they transferred hundreds of millions based on his unverified requests. Were executives equally culpable? Legal proceedings addressed this question imperfectly. Leeson was extradited to Singapore, tried for criminal fraud, and sentenced to 6.5 years in prison. He served 4 years before release due to medical issues, colon cancer diagnosed during incarceration. The punishment seemed severe for someone whose background suggested he was in over his head rather than a sophisticated criminal. Barings' executives faced no criminal charges. Britain's Serious Fraud Office investigated but concluded that management incompetence, while egregious, didn't constitute criminal fraud. Executives had been negligent but not deliberately dishonest. Several faced regulatory sanctions barring them from senior financial services roles. Chairman Peter Baring resigned in disgrace, his family name tarnished by association with the disaster. Civil lawsuits produced mixed outcomes. Partners who bore unlimited liability sued directors for negligence, arguing that management failures had destroyed their personal wealth. Courts acknowledged management failures but noted that partnership structure meant partners had accepted risk of losses. Some partners faced personal bankruptcy when creditor claims exceeded their ability to pay. The cultural impact on banking proved significant but temporary. Immediately after Barings, firms implemented stricter controls, separated trading from settlements, and enhanced audit functions, but institutional memory fades. Within a decade, similar control failures emerged at other firms. Société Générale lost $4.9 billion to rogue trader Jérôme Kerviel in 2008. UBS lost $2.3 billion to Kweku Adoboli in 2011. The specific mechanisms differed, but the pattern remained: traders exploiting control weaknesses while management trusted without verifying. This recurrence suggests that Barings' core lesson that systematic verification trumps trust conflicts with organizational cultures in banking. Firms compete for talented traders who generate profits. Talented traders resent scrutiny and oversight that question their judgment. Management faces tension between implementing controls that might drive talent to competitors versus accepting risks that talented traders might abuse inadequate oversight. Barings resolved this tension by favoring trust, with catastrophic results. Subsequent failures at other institutions show that many firms still favor trust over systematic control, apparently believing their traders are more reliable than Leeson, or their oversight more rigorous than Barings, or their culture less vulnerable to fraud. History suggests otherwise. Lasting impact. The Barings collapse fundamentally altered how financial institutions approach operational risk. The risk of loss from inadequate internal processes, human error, or system failures. Before Barings, firms focused primarily on market risk and credit risk, treating operational issues as secondary concerns. Barings demonstrated that operational failures could destroy institutions just as completely as bad investment decisions. This recognition led to development of operational risk management as a distinct discipline. Banks established dedicated operational risk departments charged with identifying, measuring, and mitigating non-financial risks. These departments analyzed business processes, identified control weaknesses, and implemented systematic verification procedures. The functions grew from small advisory roles to substantial departments with authority to override business decisions that posed unacceptable operational risks. Technology played crucial roles in this evolution. Before Barings, many trading operations relied on manual record-keeping and human reconciliation. Leeson exploited these manual processes, knowing that overworked clerks couldn't thoroughly verify thousands of trades. After Barings, firms invested heavily in automated reconciliation systems that compared traders' self-reported positions against exchange records daily, flagging discrepancies automatically without human intervention. The regulatory framework evolved substantially. Basel II capital requirements, implemented starting in 2004, explicitly addressed operational risk for the first time. Banks were required to hold capital reserves against potential operational losses, calculated using historical loss data and scenario analysis. Barings became the classic scenario used in these calculations. What if a rogue trader accumulates massive positions without detection? These capital requirements created financial incentives for better controls. Firms with stronger operational risk management could demonstrate lower potential losses, allowing them to hold less capital and deploy more funds into profitable activities. Firms with weak controls faced higher capital requirements that penalized their inefficiency. The market mechanism aligned institutional interests with better risk management. Training and professional development changed.
Financial industry professional courses added modules on operational risk using Barings as primary case study. New employees learned about Leeson's fraud as part of basic training in why controls matter. The story became institutional memory, passed to each new generation of bankers as warning about what happens when verification systems fail. Yet the institutional learning proved incomplete. The 2008 financial crisis revealed similar patterns of excessive risk-taking enabled by inadequate oversight. Firms that should have learned from Barings made analogous mistakes, trusting models without verification, rewarding short-term profits without assessing long-term risks, failing to question activities they didn't fully understand.
This suggests that Barings' lesson, verify systematically, trust carefully, conflicts with fundamental aspects of organizational behavior. Firms compete for talented professionals who demand autonomy and resist oversight. Management wants to believe their hiring and training produce trustworthy employees. Systematic verification implies distrust, potentially damaging morale and driving talent to competitors. The tension remains unresolved. Modern banks implement sophisticated verification systems while simultaneously cultivating cultures of trust and empowerment. They create controls that theoretically prevent fraud, while enabling enough autonomy that talented professionals feel respected. The balance is difficult, perhaps impossible to perfect. Leeson himself became an unlikely public figure after his release from prison in 1999. He wrote an autobiography, appeared in documentaries, and worked as a public speaker discussing risk management and ethical decision-making.
His presentations to business audiences carried unique credibility, someone who had actually committed major financial fraud, explaining how it happened and how to prevent similar failures. The irony was notable. The man who destroyed Barings now advised other institutions on avoiding similar disasters. But his perspective was valuable precisely because he understood fraud from inside. He could explain how rationalization works, how small deceptions escalate into catastrophic fraud, and how inadequate controls enable willing fraudsters.
His narrative emphasized that he hadn't planned to destroy Barings. He made small unauthorized trades that generated losses. Rather than admitting these losses, he concealed them, planning to recover through subsequent successful trades. Each failed recovery attempt increased the hidden losses and the pressure to continue concealing. By the time losses became unrecoverable, he was too deep in deception to stop. This psychological trajectory, small deception escalating through failed recovery attempts, characterizes many fraud cases. Individuals don't typically begin careers planning to commit massive fraud. They make mistakes, conceal them to avoid consequences, then become trapped in cycles of concealment requiring ever larger deceptions. Understanding this pattern helps institutions design interventions that allow early disclosure before problems become catastrophic. Barings' ultimate legacy is this: trust requires verification.
Institutions that rely on trust alone, no matter how prestigious their history or carefully they select personnel, remain vulnerable to fraud. Effective risk management demands systematic verification independent of trust relationships. The verification may seem wasteful when employees are honest, but the cost of verification is trivial compared to the cost of undetected fraud. Modern financial institutions claim to understand this lesson. They maintain elaborate control systems, employ thousands in compliance and audit functions, and submit to intensive regulatory oversight. Yet fraud still occurs, suggesting that implementation remains imperfect. Firms still struggle to balance trust and verification, autonomy and control, efficiency and security.
Barings collapsed in 1995. The specific mechanisms Leeson used, exploiting manual reconciliation and combined trading settlement roles, wouldn't work in today's automated, segregated environments. But the fundamental pattern endures. Talented individuals exploiting trust while inadequate verification systems fail to detect problems until too late. Until organizations fully internalize that verification must operate independently of trust, Barings won't be the last institution destroyed by fraud it should have detected. The Barings collapse fundamentally altered how financial institutions approach operational risk. The risk of loss from inadequate internal processes, human error, or system failures. Before Barings, firms focused primarily on market risk and credit risk, treating operational issues as secondary concerns. Barings demonstrated that operational failures could destroy institutions just as completely as bad investment decisions. This recognition led to development of operational risk management. As a distinct discipline, banks established dedicated operational risk departments charged with identifying, measuring, and mitigating non-financial risks. These departments analyzed business processes, identified control weaknesses, and implemented systematic verification procedures. The functions grew from small advisory roles to substantial departments with authority to override business decisions that posed unacceptable operational risks. Technology played crucial roles in this evolution. Before Barings, many trading operations relied on manual record-keeping and human reconciliation. Leeson exploited these manual processes, knowing that overworked clerks couldn't thoroughly verify thousands of trades.
After Barings, firms invested heavily in automated reconciliation systems that compared traders' self-reported positions against exchange records daily, flagging discrepancies automatically without human intervention. These systems didn't eliminate fraud, but they significantly reduced the window for concealment. Leeson hid losses for nearly 3 years because monthly reconciliation cycles left ample time to fabricate explanations for discrepancies. Daily automated reconciliation compresses this window to hours, making sustained fraud far more difficult. Modern systems also create audit trails showing exactly who accessed which records when, making it harder for traders to alter documentation without detection.
The Basel Committee on Banking Supervision convened emergency sessions in the months following Barings' collapse. Their mandate was examining whether existing international banking standards adequately addressed the risks that had destroyed Barings. The conclusion was unambiguous. They did not. The Basel I framework, implemented in 1988, focused exclusively on credit risk. It required banks to hold capital against potential loan losses, but said nothing about operational risks from internal control failures. This gap became the focus of what would eventually become Basel II, a comprehensive revision of international banking standards that took nearly a decade to develop and implement. The new framework introduced 3 pillars: minimum capital requirements, supervisory review, and market discipline. Operational risk received explicit treatment for the first time in international banking regulation.
Under Basel II, banks were required to hold capital specifically against operational risk calculated using one of 3 approaches of increasing sophistication. The basic indicator approach simply allocated 15% of gross income as an operational risk capital charge. The standardized approach divided bank operations into business lines with different risk coefficients. The advanced measurement approach allowed banks to use internal models based on their specific loss histories and risk profiles. Barings became the reference scenario for these calculations. When banks modeled potential operational losses, they asked whether a rogue trader could accumulate positions of similar magnitude and how much capital they would need to survive such an event. The answers drove substantial increases in capital requirements for banks operating in derivative markets.
These capital requirements created powerful economic incentives. Banks with demonstrably strong operational controls could justify lower operational risk capital charges, freeing up capital for lending and trading. Banks with weak controls faced higher capital requirements that reduced profitability and competitive positioning. The market mechanism aligned institutional self-interest with robust risk management in ways that regulatory mandates alone couldn't achieve. Firms discovered that investing in control systems and verification procedures wasn't merely regulatory compliance but competitive advantage. Better controls meant lower capital charges, which translated directly to improved return on equity and stronger market positioning. Regulatory approaches varied by jurisdiction, reflecting different governance philosophies and legal traditions.
Britain's Financial Services Authority, created in 1997 to consolidate previously fragmented financial regulation, implemented principles-based supervision. Rather than prescriptive rules specifying exact procedures, British regulators established broad principles requiring firms to maintain adequate risk management systems. Firms bore responsibility for determining what adequate meant in their specific circumstances. This approach reflected lessons from Barings that prescriptive rules couldn't anticipate every potential fraud scenario. Leeson's specific methods using error account 8888 to hide losses weren't explicitly prohibited by existing regulations because nobody had imagined that precise technique. Principles-based regulation aimed to make firms responsible for identifying and mitigating risks, regardless of whether specific techniques were explicitly prohibited.
Singapore adopted a different approach, implementing detailed prescriptive rules that mandated specific control structures. Following Barings, Singapore Monetary Authority required complete segregation of trading and settlement functions with no exceptions. They mandated daily reconciliation of all derivative positions against exchange records. They established minimum staffing requirements for back-office operations to ensure adequate verification capacity. These rules were explicit responses to the specific failures that enabled Leeson's fraud, aimed at making similar fraud structurally impossible regardless of individual intentions. The contrasting approaches sparked debate among regulatory theorists about optimal supervision philosophy. Principles-based regulation offered flexibility and avoided creating false sense of security from compliance with prescriptive rules that might not address all risks.
But it placed heavy burden on firms to identify risks proactively, and recent experience suggested many firms lacked capability or willingness to do this effectively. Prescriptive regulation provided clear standards and reduced ambiguity about compliance, but risked creating checklist mentality where firms focused on rule compliance rather than actual risk management.
The debate remained unresolved, with most jurisdictions adopting hybrid approaches combining broad principles with specific requirements for critical controls. But Barings had demonstrated conclusively that neither approach worked without genuine commitment from senior management to prioritize risk management over short-term profits. Leeson operated in an environment with ostensibly adequate regulations. The rules existed to prevent exactly what he did, but Barings management chose not to enforce those rules when doing so would have disrupted a profitable operation. This management failure became the focus of corporate governance reforms that accelerated through the late 1990s and early 2000s. Britain's Combined Code on Corporate Governance, first published in 1998, established standards for board composition, audit committee independence, and risk management oversight.
The code required boards to maintain sound risk management and internal control systems and to review their effectiveness annually. Audit committees were required to include independent directors with relevant financial expertise who could challenge management assertions about risk and control.
These governance reforms aimed to address the structural problem Barings exemplified: management teams that prioritized growth and profit over prudent risk management, with boards that lacked expertise or independence to challenge these priorities. At Barings, the board consisted primarily of partners and executives whose compensation depended on the firm's profitability. They had personal financial incentives to believe Leeson's reported profits were genuine, rather than investigating too carefully. Independent directors with fiduciary duties to broader stakeholder groups might have asked harder questions. Yet governance reforms faced inherent limitations. Independent directors still relied on management for information about firm operations. If management chose to conceal problems, independent directors had limited ability to detect deception without becoming full-time internal investigators.
The reforms could improve incentives and create structures encouraging better oversight, but they couldn't guarantee that oversight would be effective if management was determined to deceive.
The practical implementation of post-Barings reforms revealed these limitations repeatedly. In 2008, Société Générale disclosed that trader Jérôme Kerviel had accumulated €50 billion in unauthorized positions, generating losses of €4.9 billion when unwound. The fraud's mechanics differed from Leeson's, but the pattern was identical: a trader exceeding authorized limits while concealing positions through fabricated documentation, with management failing to detect obvious warning signs over an extended period. Société Générale operated under Basel II capital requirements, employed sophisticated risk management systems, and maintained governance structures meeting or exceeding regulatory standards. The controls existed on paper but failed in practice because management didn't enforce them effectively. In 2011, UBS disclosed that trader Kweku Adeboli had hidden losses of $2.3 billion through unauthorized trading in equity index futures.
Again, the specific techniques differed, but the fundamental pattern matched Barings and Société Générale. A trader exploited gaps in verification systems while management trusted reported results without independent validation. UBS had been operating under post-crisis regulatory reforms specifically designed to prevent such failures, yet the fraud succeeded for months before detection.
These recurrence suggested that Barings' core lesson about systematic verification versus trust had not been fully absorbed by financial institutions, despite regulatory reforms and governance improvements. The cases shared common elements: traders who were considered successful and trustworthy based on reported results, management teams that relied on trader self-reporting rather than independent verification, control systems that existed formally but were circumvented in practice, and organizational cultures that rewarded profit generation while treating risk management as bureaucratic obstacle. Academic research into organizational behavior in financial firms offered explanations for this persistent pattern. Scholars identified cognitive biases that systematically distorted risk assessment in trading environments.
Confirmation bias led managers to interpret ambiguous information as supporting their preferred beliefs, such as assuming that successful traders were operating within authorized limits. Authority bias made junior employees reluctant to challenge senior traders even when they observed irregularities. Groupthink in tight-knit trading teams created pressure to conform rather than raise concerns that might disrupt group cohesion.
These biases were particularly powerful in trading environments where complex financial instruments made verification difficult for people without specialized expertise. Managers who didn't fully understand derivative mechanics were reluctant to question traders who appeared expert, fearing they would look ignorant. This dynamic empowered traders while disempowering the oversight functions meant to constrain them. Leeson exploited exactly this dynamic, using technical jargon and complexity to deflect questions from London executives who lacked deep understanding of futures markets. The solution couldn't be requiring all managers to become technical experts in every trading strategy. Large financial institutions operated across dozens of asset classes and hundreds of trading strategies, each with unique characteristics. No individual could master all of them. Instead, effective oversight required systematic verification processes that didn't depend on management expertise.
Automated systems that compared trader positions against exchange records didn't need to understand trading strategies. They simply flagged discrepancies for investigation. Position limits that capped trader exposure didn't require judging strategy merits. They mechanically prevented accumulation of catastrophic positions.
But implementing such systems required management commitment to prioritize control over short-term profit, and here organizational incentives created persistent obstacles. Trading operations generated substantial revenue and profit for financial institutions. Control functions were cost centers that consumed resources without directly generating income. Managers faced constant pressure to minimize control costs while maximizing trading profits. In competitive markets where firms competed for talented traders, excessive control could drive talent to competitors with lighter oversight. This tension between control and competitiveness had no perfect resolution. Some level of control was obviously necessary to prevent catastrophic failures, but excessive control could genuinely harm competitive positioning and reduce firm value. Finding the optimal balance required difficult judgment calls about acceptable risk levels, and reasonable people could disagree about where to set those levels. Barings had clearly erred far on the side of inadequate control, but the opposite extreme of paralyzing oversight that prevented all risk-taking would also be suboptimal. Financial industry leaders argued that post-Barings regulations had overcorrected, imposing control burdens that exceeded benefits. Compliance costs for major banks reached billions of dollars annually by the 2010s, with thousands of employees dedicated solely to regulatory compliance and risk management. These costs were ultimately borne by customers through higher fees and reduced services, and by shareholders through lower returns. Some level of fraud was inevitable in any human organization, and attempting to prevent all fraud through ever more elaborate controls had diminishing returns that eventually became counterproductive. The argument had merit in theory, but was undermined by continued high-profile fraud cases, demonstrating that existing controls remained inadequate. If Société Générale and UBS, operating under stringent post-Barings regulations with massive compliance budgets, still suffered multi-billion-dollar fraud losses, the problem wasn't excessive control but ineffective implementation of ostensibly adequate controls. The regulations and systems existed, but organizational cultures and management priorities prevented them from functioning as designed. This suggested that the fundamental problem wasn't technical but cultural. Financial institutions had not genuinely internalized the lesson that systematic verification must operate independently of trust regardless of trader reputation or apparent success. They maintained verification systems to satisfy regulators but didn't enforce them rigorously when doing so would constrain profitable activities. Traders learned that limits were negotiable and controls could be worked around if they generated enough apparent profit. Management looked the other way, because challenging successful traders risked losing them to competitors. Changing this culture required more than regulations or governance reforms. It required leadership willing to sacrifice short-term profit to maintain control integrity, and compensation structures that rewarded long-term risk-adjusted performance rather than short-term profit maximization. Some firms implemented such changes after learning painful lessons from fraud losses. Others waited until they experienced their own Barings-style disaster before reforming cultures and practices. The human dimension of Barings' legacy deserves particular attention. Nick Leeson served 4 years of his prison sentence in Singapore's Changi prison before being released in 1999 due to colon cancer diagnosis. The cancer treatment was successful, and he survived to become an improbable public figure, speaking about risk management and fraud prevention. His autobiography Rogue Trader, published in 1996, became an international bestseller and was adapted into a film starring Ewan McGregor. He worked as a public speaker, commanding substantial fees to address business audiences about his experiences. The irony was unmistakable. The man who destroyed Britain's oldest merchant bank now advised other institutions on avoiding similar disasters. But his perspective carried unique credibility precisely because he had actually committed major financial fraud and could explain the psychology from direct experience. He described how small initial deceptions escalated into catastrophic fraud through failed recovery attempts. He detailed how rationalization worked, convincing himself that he would eventually recover losses and nobody would be harmed. He explained how institutional pressure to succeed and fear of admitting failure combined to trap him in an accelerating cycle of deception. These insights were valuable because they illuminated fraud psychology in ways that academic theories or regulatory investigations couldn't fully capture. Leeson hadn't begun his career planning to destroy Barings. He made mistakes, concealed them to avoid consequences, then became trapped in pattern where each failed recovery attempt increased both the losses and the pressure to continue concealing. Understanding this escalation pattern helped institutions design interventions that encouraged early disclosure before problems became catastrophic. Some firms implemented amnesty policies allowing traders to disclose unauthorized positions or losses without automatic termination, recognizing that fear of career destruction prevented early disclosure and transformed manageable problems into disasters. These policies were controversial because they seemingly rewarded rule violations, but they reflected pragmatic recognition that early detection and correction was more important than punishing individual mistakes. The goal was preventing Barings-style catastrophes, not perfect rule compliance. Leeson's public rehabilitation raised uncomfortable questions about accountability and redemption. He had committed fraud that destroyed a 233-year-old institution, cost hundreds of employees their jobs, and wiped out partners' personal wealth. Yet he emerged from prison to profitable career trading on notoriety from those crimes. Some found this deeply offensive, arguing that he should remain permanently disgraced rather than profiting from his misdeeds. Others viewed his willingness to speak publicly about his failures as valuable contribution that might prevent future disasters. The debate reflected broader tensions about criminal justice philosophy. Should the goal be pure punishment and permanent social exclusion for offenders, or rehabilitation and reintegration allowing reformed offenders to contribute productively to society? Leeson's case was complicated because his crime, while causing enormous financial harm, involved no violence or direct injury to persons. He had falsified records and lied to superiors, but he hadn't physically harmed anyone. Did this make his offense less serious than violent crimes, or was destroying an institution and ruining hundreds of lives comparably severe? Legal systems struggled with these questions when addressing white-collar crime generally. Sentences for financial fraud varied wildly, based on jurisdiction, specific circumstances, and somewhat arbitrary factors. Leeson received 6.5 years for destroying Barings. Bernard Madoff received 150 years for his Ponzi scheme that defrauded investors of billions. The disparity reflected differences in legal systems, charging decisions, and perceived severity, but the inconsistency suggested that society hadn't reached consensus about appropriate punishment for financial crimes. The institutional response to Barings extended beyond regulatory and governance reforms to fundamental rethinking of how financial institutions should be structured and operated. Some analysts argued that the root problem was organizational scale and complexity that exceeded human cognitive capacity to manage effectively. Barings wasn't an enormous institution by modern standards, employing only about 1,200 people globally, yet London management couldn't effectively oversee a single trading desk in Singapore. If competent oversight was impossible at that scale, how could firms employing hundreds of thousands across dozens of countries expect to manage risks effectively? This critique suggested that financial institutions had become too large and complex to manage prudently, and that forcing their breakup into smaller, simpler entities would improve stability. The argument gained traction after the 2008 financial crisis when multiple large institutions required government bailouts to prevent systemic collapse. If firms were too big to fail, perhaps they were also too big to manage effectively and should be forced to downsize. Others argued that scale itself wasn't the problem, but rather organizational design and management systems. Large firms could manage complexity through proper structure, clear accountability, and robust verification systems. The solution wasn't breaking up institutions, but rather implementing better management practices and governance. This view prevailed in most jurisdictions, with regulators imposing stricter oversight and higher capital requirements on large institutions rather than forcing their dissolution. The debate continued unresolved into the 2020s, with periodic crises reviving arguments that financial institutions remained too large and complex to manage safely. But political and economic pressures favored maintaining large institutions that could compete globally and provide comprehensive services to multinational corporate clients. Smaller, simpler institutions might be easier to manage, but would be less competitive in global markets where scale provided significant advantages. Barings' collapse also influenced academic finance theory, particularly regarding efficient market hypothesis and rational expectations. Traditional finance theory assumed that market participants acted rationally to maximize profits, processing available information efficiently to reach optimal decisions. Barings demonstrated that real institutions often departed dramatically from these theoretical ideals. Management ignored clear warning signs, violated basic risk management principles, and made decisions that destroyed shareholder value based on wishful thinking rather than rational analysis. Behavioral finance emerged as fields studying how psychological biases and cognitive limitations affected financial decision-making. Researchers documented systematic deviations from rational behavior that traditional finance theory couldn't explain. Overconfidence led traders to take excessive risks. Loss aversion caused irrational holding of losing positions hoping for recovery. Confirmation bias made managers ignore warning signs contradicting their preferred narratives. Barings provided vivid real-world example illustrating these behavioral patterns with catastrophic consequences. This research influenced both academic theory and practical risk management. Firms began incorporating behavioral insights into risk management frameworks, recognizing that human psychology created risks that quantitative models alone couldn't capture. Training programs addressed cognitive biases and decision-making failures. Compensation structures were adjusted to reduce incentives for excessive risk-taking. These applications represented significant evolution from traditional finance theory that largely ignored psychological and organizational factors. The technological evolution in financial markets accelerated dramatically in the decades following Barings. Electronic trading replaced open outcry floor trading in most derivatives markets. Algorithmic systems executed thousands of trades per second based on quantitative models. High-frequency trading firms operated with minimal human intervention, using computer algorithms to identify and exploit brief market inefficiencies. These changes transformed risk profiles in ways that made some lessons from Barings less relevant, while amplifying others. Electronic systems with automated verification made Leeson-style manual fraud harder to perpetrate. Trades were recorded electronically with immediate reconciliation against exchange systems, eliminating the delays that Leeson exploited. Position limits could be enforced automatically by trading systems that refused to execute orders exceeding authorized levels. These technological safeguards provided layers of protection that hadn't existed in Barings' era. But new technologies created new risks. Algorithmic trading systems could malfunction, executing thousands of erroneous trades in seconds before humans could intervene. The 2010 flash crash saw US stock markets plunge nearly 10% in minutes due to algorithmic trading dynamics, though prices recovered quickly once the systems were halted. Programming errors could generate massive unintended positions far faster than human traders could accumulate them. The speed and scale of modern electronic markets meant that problems could escalate to catastrophic proportions before traditional oversight mechanisms could respond. These new risks required different control approaches while maintaining core principles from Barings. Automated circuit breakers could halt trading when unusual price movements or volumes suggested system malfunction. Kill switches allowed operators to immediately terminate all algorithmic trading if problems emerged. Testing and validation procedures for trading algorithms aimed to identify bugs before deployment in live markets, but the fundamental principle remained constant. Verification systems must operate independently of the processes being verified, whether those processes involved human traders or computer algorithms. The question of whether financial industry culture had genuinely absorbed Barings' lessons remained contested. Optimists pointed to massive investments in risk management systems, stricter regulations, and increased public attention to operational risk. They noted that no failure comparable to Barings' complete institutional collapse had occurred at a major institution in developed markets since 1995, suggesting that reforms had been effective. Skeptics countered that absence of complete institutional failure didn't prove that fundamental problems had been solved. Société Générale, UBS, and other institutions had suffered enormous fraud losses despite operating under post-Barings regulatory frameworks. These firms survived where Barings hadn't, primarily because they were larger with more capital to absorb losses, not because their controls were fundamentally superior. The same patterns of traders exceeding limits, concealing losses, and exploiting verification gaps continued to recur, indicating that core cultural problems persisted. The debate reflected uncertainty about what constituted success in risk management. Should the goal be preventing all fraud, or merely preventing fraud from destroying institutions? Perfect prevention was likely impossible in organizations employing thousands of people in complex activities with substantial autonomy. Some level of fraud was statistically inevitable, but Barings had demonstrated that inadequate controls could transform routine fraud into existential crisis. The question was whether modern institutions had achieved adequate control to keep inevitable fraud within manageable bounds. evidence suggested uneven progress. Some institutions had developed genuinely robust risk cultures where controls were respected and verification systems operated independently of business pressures. These firms treated risk management as core competency rather than regulatory burden, and their practices reflected deep organizational commitment to sustainable operations over short-term profit maximization. Other institutions maintained elaborate control systems to satisfy regulators while their operational cultures still prioritized revenue generation over risk management, setting up conditions for future failures. The lasting impact of Barings on individual careers and institutions provided additional perspective. Many Barings employees who lost jobs in the collapse found new positions at other financial institutions, carrying lessons from the experience into their new roles. Some became particularly rigorous risk managers, having witnessed firsthand how control failures could destroy careers and institutions. Others concluded that Barings had been uniquely dysfunctional and that such disasters were unlikely to recur, leading to complacency about risk management at their new employers. The partners who bore unlimited liability faced varied fates. Some were wealthy enough to absorb their share of losses and rebuild their lives, though their family fortunes were substantially diminished. Others faced personal bankruptcy, losing not just their Barings partnership stakes, but also personal assets to satisfy creditor claims. The experience essentially destroyed the partnership model in British banking, as few individuals were willing to accept unlimited liability after witnessing how completely Barings partners were ruined. INZ's acquisition of Barings's operating businesses for a nominal £1 allowed many frontline employees to retain jobs and clients to maintain relationships, but the Barings name and legacy were irrevocably tarnished. The institution that had financed the Louisiana Purchase, supported British government through the Napoleonic Wars, and served as banker to the Queen, became synonymous with management failure and spectacular collapse. No amount of operational success in subsequent years could fully rehabilitate the reputation destroyed in February 1995. The question of whether Barings' collapse was ultimately beneficial or harmful to financial system stability remained debatable. The disaster triggered regulatory reforms and heightened awareness of operational risk that likely prevented some future failures. The lessons absorbed by industry participants who witnessed the collapse influenced countless subsequent decisions about risk management and control. In this sense, Barings' destruction served as expensive but valuable education for the broader financial industry. But the failure also imposed enormous costs on innocent parties. Barings employees who had no connection to Singapore operations lost jobs and pension savings. Creditors absorbed significant losses. The British financial system's reputation suffered damage that took years to repair. Singapore's standing as well-regulated financial center was questioned. These costs were real and substantial, borne by parties who had not benefited from the profits that preceded the collapse. Whether the educational benefits justified these costs was ultimately a subjective judgment reflecting one's views about market discipline and creative destruction. Some argued that occasional spectacular failures were necessary to keep risk management rigorous, providing dramatic reminders of what happened when controls failed. Others maintained that better regulation and supervision should prevent such disasters rather than relying on catastrophic failures to educate market participants. The enduring relevance of Barings 3 decades after the collapse suggested that its core lessons remained imperfectly absorbed. Business schools still taught the case as exemplar of operational risk and control failure. Risk management professionals still referenced Barings when explaining why verification must be independent of trading. Regulators still used Barings as benchmark scenario when stress testing bank capital adequacy. The story's persistence in professional consciousness indicated that the problems it illustrated weren't fully solved but remained ongoing challenges requiring constant vigilance. When examining Barings' collapse across the full timeline from Leeson's hiring in 1989 through the bank's administration in 1995, several truths emerged that transcend the specific mechanics of derivative fraud. The disaster reflected institutional culture that prioritized appearance over substance, relationships over verification, and short-term profit over sustainable risk management. Barings' management believed their aristocratic traditions and prestigious reputation provided inherent protection against catastrophic failure. This belief was self-deceptive. Prestige doesn't prevent fraud, relationships don't substitute for verification, and centuries of successful operation don't guarantee future survival when management fails to adapt control systems to new market complexities. The derivative instruments Leeson traded weren't inherently dangerous. Futures and options serve legitimate risk management purposes when used appropriately. The danger came from combining complex instruments with inadequate oversight, trusting a trader whose reported results were mathematically improbable, and ignoring audit warnings that explicitly identified the structural weaknesses Leeson exploited. Modern financial institutions operate in environments far more complex than 1995 Barings faced. Derivative markets have grown exponentially. Algorithmic trading executes thousands of transactions per second. Global operations span multiple jurisdictions with varying regulatory regimes. This complexity creates new opportunities for fraud while making detection more difficult. Yet the fundamental lesson remains simple: systematic verification independent of trust relationships. Technology enables this verification more effectively than manual processes Barings relied upon. But technology alone doesn't guarantee effectiveness. Organizations must commit culturally to verification as a core value, not merely a compliance exercise. They must empower risk management functions to challenge profitable traders. They must reward employees who identify problems over those who conceal them. The human dimension deserves recognition. Leeson destroyed a 233-year-old institution, but he wasn't a sociopathic criminal who planned this destruction. He was an ambitious young man from modest background, promoted beyond his competence, given authority without adequate oversight, and allowed to operate in an environment where concealing mistakes seemed easier than admitting them. Had Barings implemented proper controls, separated his roles, and verified his reports independently, his initial small losses would have been detected when they were manageable. This doesn't excuse his fraud. Leeson made deliberate choices to falsify records and deceive superiors. He deserved prosecution and punishment, but institutional failures created the conditions enabling his fraud to succeed. Management bears responsibility for those institutional failures. Whether the financial industry has truly learned from Barings remains uncertain. Subsequent rogue trader cases suggest that some lessons were absorbed while others were forgotten as institutional memory faded and new generations of executives assumed that this time is different. The recurring pattern, excessive risk-taking enabled by inadequate oversight, suggests that cultural factors preventing effective risk management persist despite regulatory reforms. The question isn't whether financial fraud will occur again. Human nature guarantees that some individuals will attempt fraud when opportunity and motivation align. The question is whether institutions will maintain verification systems that detect fraud quickly, limiting damage before it becomes catastrophic. Barings failed that test completely, allowing one trader to accumulate losses exceeding the entire firm's capital over 3 years. Future institutions may face similar tests. Their survival will depend on whether they implement and maintain the unglamorous but essential practice of systematic verification independent of trust.